Welcome back to your channel. My name is Brad. Today we're going to cover FEPI and AIPI. One, it's just a review, giving you what they're doing, and we're going to check to make sure that they're doing what they said they were going to do, just because we don't want them to not go unchecked. Like we check a lot of other people, we're going to make sure that FEPI and AIPI is actually doing what we expect them to be doing. So first of all, what makes REX shares different in AIPI than other funds? Well, first of all, they write their calls on actual individual stocks. These stocks are more volatile than regular indexes. So you can't rely on index funds to pay a higher rate compared to REX because they're actually rating on these individual stocks. Now, this is not going to be very tax efficient. We'll just throw that out. You can see the implied volatility over the last 5 years of these individual stocks. And you can sit there and say, that's interesting that these are so volatile and what they're actually paying. So FEPI is paying right around 25%, and they're targeting that number. Just FYI, there's no doubt on their call writing that they're targeting that particular number. And AIPI is right around 34.8, thereabouts. Take a couple little decimal points here or there, but they're targeting these numbers. Last distribution, they matched those numbers totally 100% right on the button. Very reliable. These numbers have been very reliable. You get over $1 for FEPI and you get over $1.40 for AIPI every single month for the shares that you own. That's a pretty healthy distribution, and there is a lot of volatility to these stocks. So you're going to see the price go up and down, but let's look at what the NAV has been since these funds have been around. The NAV has been fairly stable, a little bit up, a little bit down, but nothing really to complain about. So how does RexShare actually do this? They can't be just magically keeping these things perfectly level the whole entire time. Well, RexShares raise their calls, according at least what they say, about 5%. What you can actually see on this chart, due to volatility, 5% is an average. Sometimes it can be as high as 7%. Sometimes it's going to be a little bit lower. So you really have to take everything with a grain of salt on how far they're out of the money. And I like that. At least they're writing them out of the money by a significant portion. They're writing them farther out of the money than, let's say, the SPX or the NASDAQ index. If you didn't know, RexShares really doesn't like JEPI and JEPQ. They went to some conference and that's what everybody was talking about. So they said, hey, we can do something better. And have they? I think they have. I think they've put something reasonable together that we can have expectations. So what they're saying is they've given some estimates of out of the moneyness on the competition. This is what they say. I'm not going to argue it. You know, they say JEPI is about 2%. JEPQ is about 2.5%. We know QYLD is right there at the money. And they're rating their calls supposedly at 5%. Are they? When's the last time you checked? Stick around. The first thing that jumps out at me is AIPI is not equal weights. These are brand new. When they rolled all their calls or closed their calls and wrote new ones, I was able to capture it on the day that they did it. And what I see is they're heavily weighted towards certain stocks and they have less weight towards other stocks. One thing that has bothered me with both of these funds has really been Intel. Intel has not been a high performer, at least recently. At least on AIPI, it's a small percentage, 2.8%. That's pretty good because it's not equal weight, and having less weight towards a lower performer is pretty good. If I look at FEPI, they're all fairly equal weighted. I think at the time that they did this, they were all equal weight, and the weights got a little bit out once they published the data. But you can see where they're at. You can see that they have equal weight across the board. So if I look at AIPI, and the problem of it is when they publish this data for their calls, it can be the day before, the day after. I didn't know exactly when or what time they made the calls. So I took the same day that they published the data, I took it the open and the low for that day. Could they have written them the day before? Sure, anything's possible, and we will probably never know. But my bigger question is, are they writing them at 5% or thereabouts out of the money? And what we can see is they're all over the board. Hard to tell how far something's out of the money, but you can see some are a little bit closer, some a little bit farther away, but they're all significantly out of the money. In the end, when I started doing some averages, just to see where they were, they averaged right there about 5%. So good job on AIPI. One thing that you'll notice is they staggered the calls. Now, I didn't go in to see if they're equally weighted and how much is weighted to one and one to the other. And they didn't stagger all the calls. Just the majority of the stocks have staggered. There's a couple stocks that only have one strike against it. So it's a mixed bag if they're doing a laddered or if they're just doing a single strike. I like the laddered, but hey, they're at 5%. We're going to call it good job. FEPI, on the other hand, their sheet came out the day before. So again, we don't know if they wrote it the day before that, on that day, who knows? So I took the open and I took the low. And I looked at it and said, hey, how far out of the money were these calls? They wrote single strikes. And what you notice is it's about 5% average if you take the open and the low of the day that they wrote them. And this was the 15th. Now, AIPI came out on the 16th. So there's a day difference between when they published what the calls were. Could they all have been written on the same day? I don't know. Who would know? They would know, but we're only really wanting to check to make sure they're about 5% out of the money, and they clearly look pretty close to being 5% out of the money, which is a good sign. That will allow us to make up any NAV that we might get hit on. And we like that. We like how these guys are writing their calls 5% out of the money, and stocks go up and stocks go down. So we're not guessing what's going to do today. We're just going to collect the revenue and be very happy with it. I only need 8%. So while they pay significantly higher, that allows me to take some of that capital that I get paid and either put a few dollars back into it, which is what I'm going to do, or take some of those dollars and build out something else. And I'm doing that also. I'm only putting part of the dollars back into FEPI and part of the dollars back into AIPI. I am building out another fund. Maybe this weekend, maybe first of next week, I'm going to have an update to my 500K and exactly how much did it pay me and how much, if I annualize that, would it have been? And it's a big number. Put it like this. My retirement could almost be living off of 8% of that 500K. But I have other stuff that I'm getting money on, significantly other stuff. And having that diversification is major. I don't say go all in on FEPI or AIPI. I think that they are a nice complement to other funds to give you a little more exposure to that FANG AI kind of stocks. And so far, great funds. There is nothing you could really say, besides maybe you can write them just a little bit farther out. But that's just me. But who's going to second guess it? If I wanted to do it, I could go buy these stocks and do it myself. But why would I? I'm going to pay somebody that seems to know what they're doing consistently and do it for me so I can sleep at night and make videos for you. Hopefully you like this video. Give me a thumbs up, and I will see you in the next video. God bless.